A lot of tax decisions don't go wrong because people do the wrong thing. They go wrong because people assume they have more time. They hear that a credit exists. They plan to look at it later. And by the time they do, the window has already narrowed or closed. That's the situation we're in right now. Over the last few years, a number of tax credits expanded: electric vehicle credits, residential energy credits, efficiency upgrades. And over time, many people started treating those credits as permanent. They aren't. Under the one big beautiful bill, several of these credits are scheduled to end or change after 2025. That doesn't mean no one benefits anymore. It means timing now matters more than intent. Let's start with clean vehicle credits. Credits for new clean vehicles, previously owned clean vehicles, and certain commercial clean vehicles are all affected. Vehicles placed in service after the cutoff dates may no longer qualify. That's an important distinction because two people can buy similar vehicles for similar prices and have very different tax results, not because one did something wrong, but because one crossed the timing line and the other didn't. This isn't about rushing into a purchase. It's about understanding that credits don't phase out gradually. You either qualify or you don't. The same thing applies to residential energy credits. Energy efficient home improvements and clean energy installations can still qualify if they're completed and placed in service in time. After that, the credit disappears. Not slowly, not partially, it's just gone. That's why waiting until filing season to think about credits is often too late. The eligibility decision happens before the return is prepared. Now, here's where this conversation expands beyond energy credits, because the same timing principle shows up in other deductions that are getting attention right now. One of them is car loan interest. For the first time in a long while, interest on certain personal car loans is deductible, up to $10,000 per year. That sounds straightforward, but the deduction is narrow. The vehicle must qualify, including that its final assembly occurs in the United States. The loan must be incurred after December 31st of 2024. And income phase-outs begin earlier than many people expect. For individuals, the phase-out starts at $100,000. For married couples, that amount is $200,000. So two households can buy the same vehicle, finance it the same way, and end up with very different results, not because one made a mistake, but because income and timing landed differently. Just like credits, this deduction rewards decision made before the purchase, not after. The same timing sensitivity shows up again with Section 179. Section 179 doubled. The expensing limit increased significantly, giving business owners much more room to deduct asset purchases. But higher limits don't mean unlimited deductions. Section 179 is still income limited. It still phases out. And it still interacts with other expensing rules, including bonus depreciation. So expensing everything in 1 year can be a strong move, or it can waste deductions that would have worked better later. Nothing looks broken on the return either way. The difference is when the deduction is used. Here's the common thread across all of this. Credits and deductions didn't just get bigger or smaller, they got more sensitive to timing, electric vehicles, energy improvements, car purchases, business assets. Once the window closes, there's no way to recreate eligibility after the fact. That's why planning now looks less like chasing incentives and more like aligning timing with decisions you are already going to make. The people who benefit most aren't reacting at tax time. They're deciding early and letting the math follow. All of these rules apply to 2025 tax returns. And by the time most people are filing them, the timing decisions are already set. It's important for a tax professional to assess your tax filing and planning situation with the one big, beautiful bill in mind. Click the link in the description to request a tax strategy call. We use a short questionnaire to make sure this is a good fit for both sides. Please like this video and share this to someone who can take away some key points from this video.